Is the home equity conversion mortgage for purchase H4P really a retirement game changer or just a retirement pitfall? Let's talk about it this week here on the podcast. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into the show. Thanks for hanging out with Phil and I as we talk investing, finance, retirement. Phil, it's a mouthful. I'm not even sure I want to say it again.
I was going to say
it's the home equity conversion mortgage for purchase. I'll make sure I'm looking at it and reading it. The H4P. What is this, and what do you think about it? Is it got any merit? Is it is it worthwhile?
I mean, at the end of the day, it's a reverse mortgage, right? And the reason they don't use reverse mortgage is because that's got a bad name over the years, which absolutely has. I mean, it's, in the past, reverse mortgages were not a good product. They weren't as regulated.
Okay, Phil, so it's got the Madison Avenue rebranding makeover that junk bonds got, right? So it went from junk bonds to high yield bonds. I mean, I don't know about you, but high yield sounds much better.
Yeah, so well, it is, and both of them are true. It's it is what it but it's just kind of a rebranding of it, and it's being used. It's using that reverse mortgage in a very specific way. So I guess I would say, kind of at the beginning of it, what is a reverse mortgage, and why would he even talk about it versus some other option? So it used to be, back in the day, reverse mortgages were generally not a good option. It was kind of like the absolute last resort, right? You ran out all the money, you got equity in the home, so you did a reverse mortgage. And a reverse mortgage is basically where the bank is going to give you money, but they don't expect it to be repaid. But they're not forgiving the interest. The interest just accrues internally on this mortgage. And it used to be such that, with that reverse mortgage, I mean, if you ended up dying, well, the bank kept the house. Back in the day, they were not really good products. They were not as regulated as they are today. So there were some pretty unsavory things happening in that industry. But with that comes regulation, right? So at the stage we're at today, it's a viable product. It's not the product it used to be, because today that doesn't happen, right? So I mean, if you end up passing away, the bank has a mortgage on the house, so you sell the house and you just get it paid back, and if there's equity, then that goes to whoever you want. So it's no different than any other mortgage. So
Phil, this really is a mortgage. I mean, to make sure I'm getting this right, so I'll just kind of do a quick breakdown using my own family or household. We only have the one kid. There's no kids to fight over anything. So by the time, God willing, I live long enough, by the time I get to the point where I'm no longer here, she'll probably be like almost 60, or at least in her 50s, probably doesn't want the house, doesn't need the house. So if we did a reverse mortgage, a typical traditional one, I suppose, I pass, the wife stays here till she passes, then they sell the house. And of course, that kid has the right to buy it back if they'd like. They still have to buy it. So kind of the same thing, right?
Correct. That's what I was saying. It's a mortgage is all it is at this time. It's a reverse mortgage, in that meaning that you're not making monthly payments against it. So, I mean, that's the benefit to a retiree, because, and we've talked about this many times on the show about home equity, right? The challenge with home equity is that it does nothing for you. It doesn't grow and generate revenue. I mean, your house grows in value irregardless of a mortgage. So when you have home equity, if you needed to get that asset, and for a lot of retirees, home equity is one of the biggest assets they have. If you ever need that asset, there's really only two options you have. You either sell the house, or you have to get a mortgage against the house, which now has, this repayment. Well, in retirement, that can be a challenge, because from a bank standpoint, if they're going to give you a mortgage, they want to see your ability to repay. Well, if you don't have income to begin with, and that's why you're going to the equity of the house, well, how are you going to repay a mortgage? So therein lies the problem, and where a home equity or reverse mortgage like this might come into a benefit, because you can take that mortgage out. You're not repaying it. Yeah, it's accruing interest, but that just goes against the equity in the future, that when you passed away, then the kids, if they want the house, they pay the mortgage off. And they're not outrageous rates compared to what a mortgage rate would be. They're pretty similar, maybe a little bit higher. There are some additional costs to get into them up front. So they're more expensive. But the reason for that is this. So with a traditional mortgage, at some point, if you sell the house, think of 2008, right? If you sold your house and it was worth less when you sold it than what the mortgage was, well, you're still on the hook. So if your house was, you had a mortgage of 300,000, but your house now went down to 250, well, the bank still wants their 300. So they're going to come after you for that extra 50. With a reverse mortgage, the way they work today, that doesn't happen. So, I mean, if the house value is less than what the mortgage is, then the bank can't come after you or the estate or the kids or anyone else. It gets wiped away, and they're buying a policy against that is why there's that extra cost up front.
All right, Phil. So in today's housing market with, housing prices all over the place, right? Super skyrocketed all over the country, anywhere, 30 to 400%. I would assume that you're getting the value of the current pricing, right? So does that hold true? I mean, it seems like it would.
Oh, absolutely. Because it's based on value, and it's not like a traditional mortgage where, you might only have to put 20% down. So the bank's going in with 80%. Reverse mortgages, because of the risk they're taking, it's a much lower percentage of the value they're going to give you. So it's, you're not getting as great of leverage, so to speak. But again, the reason for that is because there's risk on their side, potentially. And there's a lot of approaches with reverse mortgages. One of them is this concept of a line of credit where, just like a home equity, right, where you have this line of credit that you can pull from when and if you need it. You don't have to take all of it. You don't have to take monthly, but you can. And the way reverse mortgages work today is that they have built into them that equity line grows each year, irregardless, at a fixed percentage, irregardless of what the home value does. So that's why there's this insurance built into it that says, hey, if at some point you die and the mortgage is more than the house value, then the insurance company has bought insurance, or the mortgage company has bought this insurance on the side to cover that.
All right, Phil. So worthwhile conversation for folks. I mean, whether you need the money, don't need the money, want to unlock the value of the house, viable retirement strategy for some people then?
Oh, absolutely. So, I mean, it used to be the reverse mortgage was, like I mentioned in the beginning, kind of the last resort, right? I ran out of everything else. I got to get the equity in the house. This is how I did it. It's not that anymore. I mean, there's many, many other options for it. It gives you access to the equity in the house, where you might not be able to get access without selling it any other way, right? And I mean, there's an article that we can put up a link to that talks about this, specifically this H4P, home equity, what they call conversion mortgage. And how this one worked is there was a scenario where this individual wanted to switch houses, basically, right? So they were in a house that had multi-levels. They couldn't handle it anymore. They were trying to go to a ranch style house. And in today's market, yeah, you're paying more for that house, right? Or they were wanting to upscale the house a little bit. So they were going to sell for 300, I think, and they were going into a house for 5. So in a traditional fashion, you're selling for 3, you're going to have to, then get a mortgage for the extra 2. And now we're back to that whole, thing of, well, can I support the payment on that extra 200,000 for 30 years? Is the bank going to give me that mortgage? All the scenarios that run into that. So how this home equity reverse mortgage works is they sell the house, they put that in to the new house, but then they take the reverse mortgage for the extra 2. So they're never having to repay this. And yeah, that reverse mortgage, it's growing and accruing interest all the time, right? So just like a normal mortgage, the difference is you're not paying it. But the way it works is typically, especially if home values are going to increase, your equity probably in this scenario they were showing stays about the same. But the point was, for like this individual, it helped them do that switch to a house that now fits their needs. And they didn't have to come out of pocket now monthly for the additional cost of the house. The other thing that they have to consider, though, is property taxes, insurance, then the different house, that piece of it. I mean, that's out of your pocket. But from the mortgage standpoint, you don't have to worry about that. It's not like now I've got a $200,000 mortgage. It's $1,000 a month or whatever it is. And how am I going to pay for that? Can I qualify, et cetera? I'm able to make this switch, get into this house, and it now fits the need that I have. So, yeah. So, I mean, reverse mortgages, understand what they are. Don't, like many things, right? I mean, there's a lot of different products out there that everyone has a love and a hate for something, right? So don't just listen to, oh yeah, it's a bad product, never do that. Or, oh, it's the greatest product on earth. Understand what it is. It's a tool. For some people, it fits really well. For this type of a scenario, it can work really well. There are other scenarios that it can work really well in too.
All right. So look, I mean, it's another one of those financial products, those financial pieces that, you don't want to just make a rash decision on. Always check with a qualified professional. If you've got questions, and I'm sure you do, we'll probably wind up doing a follow-up conversation on this as dive in a little further, because there's a lot to things, just like annuities got a makeover and they're not the same as they were 20, 30 years ago. Same thing with reverse mortgages and this new H4P. And if you need help, please reach out to a qualified professional like Phil.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
All right, that's going to do it this week for Phil's Tax Hacks and other retirement facts, as always, with Phil Putney. And if you've got some questions, reach out to Phil or a qualified professional. You can find him online at philstaxhacks.com. Have yourself a great week. And don't forget to subscribe to us on Apple, Spotify, and YouTube. And we'll catch you next time here on Phil's Tax Hacks and other retirement facts.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.